Alrighty, we're up and running. Sorry, I just realised I've not got the chat up. There we go. Okay. So I just make sure that I can see it. There we go. Right, okay. So plan today, there was a couple of things I wanted to finish off on crises and the sort of special situation ones. Mainly limit downs and then the sort of escalation of a crisis. The next thing we'll then do is do a bit on correlation. So we'll touch on correlation a bit this morning on sort of the basic sides of correlation. I've got a nice little challenge for you guys for over lunch to go on replay. I'll explain that one in due course. And then this afternoon we'll do a little bit on bond correlation and the implications of that. That's where it gets a bit technical. So get your thinking caps on for this afternoon. Right, like I said, we'll finish these ones off. Okay, real quick, I'll just answer Grimey's question on the S&P Open, because I said yesterday, generally you don't really want to be trading around the Open. We'll perhaps talk about it this afternoon. What I would suggest on the whole is the way to approach the Opens. Sorry, my pen's not working. I think 15 minutes can start to give you a clue. So we'll perhaps have a look at that this afternoon very briefly, after about 15 minutes, as to whether you've got any clue for future direction. It still doesn't mean that you will. There are some Opens where you get 15 minutes in and you're still sitting there going, I still don't know what's going on. That's fine. There's no problems with that. The worst thing you can do is sit there thinking, I don't know what's going on, but I want to trade, and start clicking away. That's the last thing you ever want to do, because that's where you're going to get yourself some serious trouble. Right. Let me just get this to go away and then come back. There we go. So that's what you don't want to be doing. Right. Let's get on to limit downs then. We talked about this the other day, about the whole idea of how you play a limit down. Get short the limit, wait for the break to come. So the other point was around making sure that you've looked at the European markets. European markets are really helpful because they don't have a limit. If I get time, or I might sort of post an image up, what European markets do have though is a volatility stop. American markets do. Europeans have a volatility stop which is spectacularly vague as to what constitutes a volatility stop and what the criteria is for one. It is not on the Eurex website. They do not tell you what would constitute volatility stop, but they can happen. And when it happens, you get a little box that moves, and that's it, and you wait till that reopens, and there's also no indication on their website as to what criteria goes into when it would reopen either. So it is a... Well, it's just a horrible period of uncertainty if you are in a trade and it what you call white boxes and you've got no idea what's going to happen next. Sometimes it's good, sometimes it's bad. Right, so we're going to go and have a look at a couple of, or at one of these, particularly the one that I suggested from not the 15th of March, but if you want to go and have a go at a limit up, the 15th of March, we had a situation where the SP went limit down the day before and limit up the next day, which is pretty impressive to do that. Like I said, with all of these though, every single limit, when it opens, they all reverse at some point. It's easy to say they all reverse at some point. When exactly they reverse is the hard bit. Limit ups seem to have less continuation in them from sort of anecdotal experience rather than me being able to actually, well, there's not enough of them to make this difficult to go and find. I could find all of them and go, yeah, look, they don't go massively far. I don't know if that's the case that, you know, I guess people don't panic buy. You're in the middle of a crisis, how much do you really want to panic buy when you've just limit up 6-7%?
When you're long and you're limit up, sorry, if you're short and it's limit up, you get margin. Does everybody get margin call on the limit up? So market opens and it opens limit up. Does everybody that was short get margin called because they were short whatever, 5% lower, and now all of those people get margin called and their positions get wiped out? Or how do the mechanics work of actually it has to open with a non-limit scenario in order to be able to fulfill that trade? There won't be enough liquidity, presumably there wouldn't be enough liquidity to fill all those orders as they've gone up, as the market's gone up 5%, right? So you're going to be stuck with, let's call it simplistically, you've got 10,000 orders. 5,000 orders got filled on the way up. There's still 5,000 there that never got filled. So does that, and they haven't been filled because the market is not trading because it's gone limit up. So unless the market does another 5,000 on the limit to consume all the ones below, then presumably those people are still in their position. Do you know?
I think I see what you mean. Well, yeah, when it goes limit up, I'm
sure that whatever that line is, that big thick line there. And limit up, yeah.
So that's the limit. But yeah, if you were short going into that,
yeah,
you're short, it goes limit up. you're just short. There's nothing you can do about it.
I have to be filled to be out. I have to be filled by a buyer in order to get out.
Yes.
And if I'm not,
So you can join the bid at the limit up and hope that someone will sell to you.
Yeah.
If no one sells to you, you're still short, and if it opens there or there or who knows where, you're still short. When it comes to margin, I don't know at what point they would margin call people.
Okay.
Because like to put any trade on, you have to post margin.
Yeah.
So your margin's posted. Let's assume that you're not short from 5% lower, in which case your margin would pretty much be all wiped out. Assuming you're not, I don't think you get margin call till the end of the day.
Okay.
The margin call will come at the settlement at the end of the day. Don't quote me on that. It might be worth looking at CME.
Okay.
But as far as I'm aware, to place a trade, you must have posted the margin anyway.
Yeah.
So unless they're going to increase the margin whilst you're in a trade, which as far as I know they don't do.
They can only do it as you approach the close of the day.
Yeah, they can announce that they will increase margin, but that would only be brought into force on positions you hold at the end of the day.
Which they did in 1987, I think they forced margin increases on all the open positions in order to make sure they had enough cash to cover
Right.
the close of the day.
Okay. So you might have that. But yeah, ultimately, until you get to the end of the day, you don't know, as Warren Buffett put it, you don't know who's naked until the tide goes out. So you find out at the end of the day. But yeah, that's basically what happens. So most people get away with it. If you're short on the limit, this is not advice to go short a limit or long a limit down, because some of them won't come back, particularly commodity stuff. We've heard of things like orange juice just going limit down 3 days in a row. And so, yeah, it's a disaster. I don't imagine you get that kind of thing in equity market, but there's nothing to say it won't. The other thing to bear in mind, like I said, there is no limit down in, I think, well, certainly oil, there isn't, because oil did it on the 9th of March, it gapped down about 30%, and there was no limit. Or sorry, it gapped down 25 and then traded down to 30% down and still no limit, and then it went negative, so I don't know how you do a percentage there. Right, so yeah, 15th of March, if you want to go and have a go at a limit up. Same principle again with the Europeans though. As soon as the US hits the limit, the Europeans then continue onwards. You get this continued bid. You also then get further bounces from when it reopens. Right, but I want to get on to the one that we're going to go and have a look at, which is this one. What I've got it done in 2 videos. One is the playing the short on the limit and the playing the short in the Euro stocks when the S&P hits the limit. The other is then the reversal of that short. So I've not got the whole bit from here all the way down because it's sat on the limit for about 15 minutes. That's the only thing that I think they may announce when they will release it, but there's no sort of defined rule as to when the limit gets released. It's just released when they deem that markets have regained sufficient degrees of calm, if you will, or liquidity, and then they'll reopen the limit. Let's everyone chill out for a bit. Okay, so the idea here then, the S&P hits the limit after having opened from a 5% limit down. It opens, flash around, trades to 7% down, and then goes limit down again. Hits that limit, stops. Then you're waiting for the reopen once more. In the meantime, once the S&P hits the limit, then the Euro stock starts to sell off. That's the main part of the trade. That's the S&P hitting the limit. So S&P hits the limit, then everyone starts selling the Euro stocks as a way of hedging. So that's the approach that a lot of people will go down. You try and get short the S&P limit, and then you sell the Euro stocks at the same time.
It's interesting. I thought hedging was always like you buy something and sell something, but you can sell something and sell.
Well, but that's not a hedge. That's an outright trying to play for the break. The idea of the hedge, is if you're long and the S&P's hit the limit, so let's say you were long up here or you were long when it opened, more likely, and you tried to buy it and it goes limit down, then you sell the Euro stocks so that if this does gap another 2% down, what you lose on that, you should theoretically make on the Euro stocks. So at least you're no worse off for it. It's never a perfect hedge either. So there's always going to be an element that somebody might have sold more Euro stocks than they should to cover their S&P, or not enough. So you still get a reaction at the open as well. So there you go. Worth a go. Go and have an attempt at it. I wouldn't start a hedge fund. I'd just sell the limit down if you ever get the chance.
That's exciting.
It's far easier just sell the limit down. All right, I won't play the full 11 minutes of it because you don't need to see that there. This to maybe this was at the start of the ECB press conference as well, just to add to the volatility. ECB at this point had cut rates and started QE in a very minimal fashion. They went, oh, we'll do 120 billion, and that was it. Nothing more. Useless. This is what you'll get on the S&P. So this is trading around about here now. Tick down. You know where the limit is. Yeah, everyone's going to know where that limit is. Trace the limit. As soon as it gets there, you then can't trade below there, and you get this big order sitting at the low. So that's what will then just start to tick up and tick up and tick up and tick up. Once you get to this point, you can see that it does still trade. So you can join the limit. Join the limit. As long as it keeps on ticking through, you'll get filled. There is always a risk that it does this and it flicks off the limit. How you deal with that? I think there's a couple of ways. One, you can try and get out every time. The problem there is you could end up getting out, get out, and then it goes limit and you're not in. So I think what you've really got to do is go, okay, I'm playing the limit down. That's the point when it locks, when it shows you a bid and an offer at both sides. You can't do anything now.
What makes that lock though?
It's CME. Once it's hit the limit, I don't know on the once New York Stock Exchange is open, how quickly they do that. It may be that the NYSE says limit and that's it. But yeah, there's a point where CME just decides. When it's pre-cash, it's 5 minutes before the open. But when it's during cash hours, then it's just they lock it. I think once it doesn't seem to want to bounce off it, but I don't know quite the criteria on it.
Also depends, right? Because it depends what's gone limit down in the NYSE, right? Because the S&P futures can go limit down. The S&P 500 is made up of 500 different stocks that may or may all not be limit up or down.
True.
And equally, they might not be in extreme volatility. They might not be able to make a market in some of those shares, and therefore cause a massive misprice for the S&P. Therefore, the S&P can't open until they can understand how can they price it. Otherwise, you might get massive.
There could be a bit of that because you won't have quotes on some of them.
Yeah.
But I guess they look at the index, the S&P index, and as soon as that hits 7%, then so the best way to look at it is the SPY ETF, and use that as your sort of indicator.
So the best time to take this trade is pre-cash open. If we see, pre-cash. Yeah.
The ideal is pre-cash,
because
theoretically when the cash comes in, then you're likely to get a bigger gap down. But that's cash. So it had opened, it was limit down, drop, and then went straight to the next limit. So that's gone from 5% to 7%, and then it sits on the limit until they deem that there's enough liquidity, enough kind of, orderliness in markets that they can reopen.
Does it drop at 7 or 5? I wrote down 7.
So they've changed the rules now. There is no 5% pre-cash limit. It's only 7. Which now means that come the open, so the NYSE open, you would then have a situation where you'd be on the limit 7% down. They will reopen that. The next limit is 13. So it'd be somewhat spectacular to go to the next limit now. But what it does suggest is there is a lot of empty space to fall into. I would expect now with that, because there's not much space, because there's so much space, you're probably going to get a volatility stop. It'll reopen, it'll shoot down, and it will move so quick that it will then lock out again, and you'll get this kind of moving volatility stop, but it won't be a limit. So then you treat it like, we looked at the Sunday open trade, you'd have that type of idea.
But it will stop, and will you still see bid and offer?
You'll just see it bid and offer the same price, so and it will just go up and down. You can't do anything.
You won't be able to enter?
No. You can place an order above or below the box, as I would call it. If you place a bid above the box, you will get filled on the box wherever it opens, as long as it's below you. And if you place an offer below, you will get filled short wherever it opens.
But on a limit down, it's better to place an offer below, right?
You can't place any orders on a limit down. Once it's limit, when it locks, it will then have a reopen. I'll show you the reopen in a moment, which works like an auction process. So once it locks from this point, when it gets to the point where they're going to reopen it, it will then auction. So you'll see the box start to move again. Once the box starts to move, then you can place orders, and then it will go. That's the whole idea. Basically, it's pretty straightforward. You sell the Euro stocks on that. It's hard. The hard bit is knowing how much you're going to get out of it. part of the sticking point in Euro stocks once it's had the sell, so I think I started at around 20, I think 2025 area. It's a decent move for stocks. Part of what will get this to stall is once the box starts auctioning on the S&P, then the hedge doesn't need to be on so much. You know, if you sold this to cover your S&P, you now know whether you've covered enough or not, and you know where the S&P is going to reopen. So people will start to sort of get out, which will slow down the Euro stocks. So unless the S&P reopens and goes again, the stocks won't likely follow it once again. And
So if you see, for example, the price coming back to 6.8% or 6.9%, would you enter a trade short?
I would look at it more as a case of if you're on the way going towards it, if you've got any reason to be short, which is probably going to be a lot if it's 6% down.
There's a reason for it.
Yeah. If you can get short, try and hold it so that you're short as it hits the limit. Because if you're short above the limit, you're in a great place, because then, you know, I don't know, your 20 handles on side, it goes limit. I can't think of a situation where it's gone limit down, bar, I'll show you in a minute, the unlimited QE day, where it has not gone through the limit. Okay. So if it's on the limit come the New York Stock Exchange open, or on the limit during New York Stock Exchange hours, I have not seen any of them fail to open lower and go down again, at least to some degree. How far it goes when it reopens, who knows? Okay. And obviously there's a limit to how far it's going to go before you have to go there. I'm going to bank this if it opens there.
Just one quick question on that video explaining on the left on the stocks. The note says leaving on the LBN, like 2 minutes ago, leaving on the LBN for the next rush down. One question about that. In these kind of scenarios, would you expect, you know, principles being, once the LBN goes, normally the idea is over, right? So especially in the ordinary trade, comes back to the LBN, trades through the LBN, then that's a really strong proof that trade is no longer on.
Yeah.
Does that rule apply in the same principle here in a high volatility, or would you try to give it a little bit more flexibility?
You might be willing to apply a little bit more flexibility, but on the whole, the rule still applies, or the sort of idea would still apply on the basis that yes, maybe it could go through fill the mid 80s and go again, but if it doesn't and it goes through the mid 80s and then starts going up, the last thing I want is still to be short, going, well, this was a good idea, and now I'm back at scratch type of thing. Yeah. So there's a bit more sort of flexibility in the way it moves, but ultimately the principle remains the same. And there you go, that's the problem you get if you don't give it up when it goes through the LBN. Because you also got to remember there's a lot of other quite short time frame people who are all thinking the same types of things. The good thing about volatility is it's all the same stuff, it's just faster. So in a sense, you can give it a little bit more flexibility in terms of number of ticks, but if it starts to look bad, don't hang around, because that will also translate into 20-25 ticks against you as well. So that's the whole idea of it. That then starts to hold. That would definitely be my point, to give it up. With something like this, you're selling this as a hedge on an S&P, or a hedge theoretically. You don't know how far that's going to go, partly because you don't know where the S&P is going to reopen. One way you can look at it, look at the indicated open of the SPY. So they'll give you a quote of the indicated open. That at least will direct you to where you think the S&P is going to open. Like I say, you will also get the box will start to move at some point. Once that starts to move, the clue's there. I'll show you the reversal attempt, which at least will give the execution on the box. So that's then what we've had now is the limit down, then then it's traded down to here, and that's now where the box is going to reopen. So it might have just opened actually. So that's what you'll get. It will sit there, and this would have then have started to move. As soon as it starts to move, you're able to put bids and offers in again. So now you're in a situation where you've got bids and offers on the ladder, the box has moved, that suggests you can do this now. You can try and get in. The idea would be generally to have a go at selling it. Or that, the general idea is whichever way the box has gone, you sell it, or you go with the box direction, on the basis that there are still people who would have been long who are now going to have to stop out on the reopen of the box. Obviously, the further and further you go, the more and more you've got to think, is this really going to go again? But you have to sort of think it's at least in the short term likely. The other thing to do in these situations is look at other markets. So look at correlated markets as to where they are. Some part of the idea of playing the reverse on the S&P here is that Euro stocks is now trading 26.12. On the last bit, it was trading 25.68. So the Euro stocks actually bounced quite a bit. Decent reason to think the S&P is not going to be able to sustain this continuation. I'll show you, perhaps at some point in the future, I'll show you an example of doing that in the Bund on an ECB, where it white boxes down and then the box opens up because of the BTP. So that reopened and then instantly volatility stopped again. That will be the reopen and then volatility stops again. So you'll get a lot of that. As soon as it reopens, you then get the rush up, which is going to be the first people taking their profits. So the difficult bit about selling it is that
Did you get out quick?
yeah, because people who have sold up here or have sold this one, a lot of them, the shorter time frame people, are also going to be the people trying to play to get out of their shorts. The first time's the best. The next time, increasingly it's going to get more and more sketchy selling the limit because there's going to be a lot of people trying to bank their profits on this. Like I say, you then get this very, very thin, quick trade. When the limit opened, it was at 19. The Euro Stoxx was at 12. So there is this element as well. The S&P is still going down whilst the stocks is going up. You have to look at that and think it's hard to justify the S&P continuing to go down whilst the Euro Stoxx doesn't. Yeah, the Euro Stoxx is sat reasonably still here.
Why do you make that correlation? Why couldn't the S&P just keep going and the Euro Stoxx turn around and go with it? Why do you?
Oh, as in, why wouldn't it
Well,
keep?
Yeah, if the logic is, well, the Euro Stoxx is holding up, so therefore probability the S&P won't keep going so far. What is it about the Euro Stoxx holding there that means that it allows you to draw?
Yeah.
Draw that assumption?
My conclusion on that is based on the idea this is the one that's been trading all the time.
Right, okay.
So this is where it is because of the ability for it to trade.
Yeah.
This is jumping around. My take would be in the first couple of minutes on the basis of people getting in and out of positions that
Because it's the open of them.
they're dealing with the positions that they've got or don't have. Whereas this is here because that's there, as in that's traded to those prices. So it's done it more freely. The S&P has started going now. So you're still in a situation where the S&P's done 20 handles to the downside and the stocks has done 10. They're trading at roughly the same, or almost exactly the same prices. So for that to do 20, this should do 20 as well, which it nearly has, to be fair. But yeah, on the whole, my sort of thought would be, compared to how low this got, the S&P's not matched that. That would be the kind of thought on it. But yeah, the idea here is they're trying to play the reversal back, which is a really tricky trade to play.
And the break of 2496 is because that's where the low volume node is, right? Because you've got that.
Yeah, partly.
Yeah.
Yeah, the S&P's a harder one to read in these types of circumstances. It's so quick. But yeah, partly that's the idea of it. But you saw it do the volume down at the sort of 95 area. Once it starts to come back, then it does start to run. Yeah, these pretty fast moves. Like I said before, with volatility, you can't sit there and go, oh, quick, I'm on side. Yeah, I'm on side 10 handles, quick, take it. You've got to look at it and go, look, I'm playing for wherever. My assumption there would be to play for that, the re-close of the gap, which is 46. So you can't sort of get spooked by the whipping around. You're almost better when it gets to this level of volatility to get rid of the quarters, even on the S&P. And bearing in mind, this is at 2,500. So you can imagine that's going to be nearly, double the speed now, or double the size of movement. You've got to be on quarters when it gets to this level of volatility just to be able to cope with where it is on the screen. You can imagine what the Nasdaq would look like, which is where everyone just goes away from the Nasdaq because you just can't you can't get any handle on what's going on at all. And so what I'm generally looking at is the sort of range of movement. It keeps going up to about 12, and then it was down to 05, it was 12.5, 12.5. Then it's gone 19, it just traded 24. So it's then got 12, 24, 19, 26, 7. That seems to be the point that it's sticking now, 26, 7. But you've then at least, I sort of see it, and it's sort of in steps now. So I wouldn't expect it back below 12, and really it's not even come to 19 again. So you're thinking, right, now we're okay. It's back over 19, which was the original open. It's not rolling back. Now you can start to look at the 46 as your target. He's come out of it a bit quick, but there you go, that's the whole idea of it. But the other point would be you've got no volume there. That was where volatility stopped down again, or sorry, where it pinged up on that initial first spike.
Yeah.
So that's then the other point that you go to there, and then you see if it can go through the gap. But that's the whole idea of that one.
And in good traditional style, it rips through and catches out everybody that was short. Catch them all offside as well.
Yeah, well, yeah. Once it starts on this bit of the move, you can then play it back through the open of the next one and try and play that up. That's the only one I think that didn't fully reverse the whole limits all the way back. It at least reversed one, and then it reversed it all the next day. So I think the next day went limit up, but it reversed the whole lot the following day. But there you go. The theory of the trade works, that you can play the reversal. The practicality of playing it is really tough in terms of the scale of movement that it's going to do before it puts in the reverse. And the fact that also, in reality, you would have probably tried to play that one as well for the one back, which again, makes it very difficult to actually genuinely play this as a trade. But the main bit was to sort of see that reopen and just be aware that you're going to get a few volatility stops when that happens. Right. Okay, final thing on crises was it's all right, what you end up with, what you call a dash for cash. This is the bit I was talking about the other day, when you end up with a situation where people just want dollars, predominantly because of dollar denominated debt. There is so much of it out there. If your currency is depreciating, your debt increases in cost. So you need to get hold of dollars as fast as possible. That shows up as a cross-currency basis, spread widening, that you can effectively charge a huge amount of money for dollars if you want to, well, if you're lucky enough to own them. The solution to this is not always dollar liquidity, but they will do liquidity swap lines. This is effectively a loan from central bank to central bank, as in the Fed will loan dollars to the Bank of England, because there's going to be UK banks that need to get hold of dollars. The Bank of England would also do the same to loan pounds to wherever. It's on the basis they will get paid back. So it's effectively a short-term repo.
They print that money?
They would effectively print the money, lend it to the Fed. The Fed will, well, they probably don't even post collateral. Yeah, the Fed's good for it. So the Fed will then swap that for dollars. So we send them a ton of pounds, because the Fed can't print pounds, we can't print dollars. We say, right, we're willing to print up to 100 billion sterling. You give us the equivalent dollars. Therefore, when UK banks come to the Bank of England and they go, we can't get hold of dollars from anywhere, please give us some, the Bank of England can. And that's how it works.
Increasing money supply increases inflation?
Not in the real short term, it solves the problem.
And in simplistic terms, the actual creation of that 100 billion is somebody going onto the ledger of the Bank of England and adding in
A zero.
that amount of money onto their balance sheet. Just like that, the money is created just as simply as that, right?
Yes,
What system
essentially.
they use, but somebody just adds add this amount to our balance sheet.
Yeah, and theoretically, it shouldn't have too much impact if it's done as a repo for a 7 day, 30 days. Yes, that money appears and then disappears, but it never really gets into the real economy, so it doesn't create inflation. It's there to effectively, you'd think of it almost as almost a blood transfusion for a bank. They've been in an accident, lost some blood, put some blood in quickly, get them better, and then, well, you don't take it back, but they can create their own by that point. I'm not a biologist.
Do they get their money from the bond market somehow by issuing?
No, you just print it.
Print it.
Yeah, you just go, right, just add a zero on there, give that to the Fed, everyone's happy. that is essentially it. I guess it would be like, if I could just create some money, lend it to you for a week on the basis that you will give it me back, and then get rid of that money, no one's any worse off. You give me some collateral in the meantime. It's the whole point is this is a liquidity solution. You have the ability to pay, but you don't have the money now. So the central bank steps in and provides that liquidity, because people are good for it.
So
but
you go long the dollar and short the currency that they're giving the country to?
yeah, but basically the strategy is just long dollar. Yeah, as a play, you when this starts to happen, what you start to see, this is the whole idea of it. I'm not going to go into loads and loads of detail. Straightforward FX swap. We exchange sterling for dollars now, and then agreement is in the future, we will swap it back at an agreed price now. So it's a spot transaction with a forward transaction. There is nothing to mitigate exchange rate risk. So we agree the price now. Your problem if the dollar weakens or the pound strengthens or whichever way, and you each have an exchange rate risk. To mitigate that, you enter into a cross-currency basis swap where you then pay interest in the currency that you borrowed. So if you borrow dollars from me, you pay me dollar LIBOR or dollar SOFR as it'll be now, and I will pay you sterling SONIA. That way, theoretically, the interest payment should match off against the exchange rate risk. Because if one starts to strengthen, you're probably going to pay a higher rate to get hold of that. So if you've got dollars and they strengthen, I don't want to lose out when I get them back because I've agreed a weaker point to get my dollars back, but I'm compensated because you're going to pay me more interest on those dollars because it's a floating rate of interest. That's where you started to get. So that spread went out to around 85 basis points. Bear in mind, this is dollars to euros, which is pretty safe money, euros. Imagine if that's dollars to Turkish lira or pesos and things like that. Financial crisis, it went to 225. So you're paying over 2% to get hold of dollars on a very short-term basis, which is enormous. So that's your big kind of indicator. You don't have to be watching this necessarily. It's the kind of thing, once it starts becoming notable, it will start getting mentioned. So you don't need to have a chart of it. It's quite hard to actually get a chart of these types of things. Google it, you probably find something. They'll start publishing it on Bloomberg each day.
And as soon as it's the news-wise, straight away.
Well, this is more of a correlation type thing. That what you will start to see
Over time.
is the trigger of this was the 9th of March weekend, where Russia walked away from a deal with OPEC. Basically, there was a deal whereby they were going to cut oil supply because oil was falling out of the sky as it was. It dropped to like $40. The OPEC Plus deal, which is OPEC plus Russia, was an agreement that they would cut oil production by 1.5 million. That was discussed, and then basically Saudi Arabia turned around and went, and half of that 1.5 million is Russia's going to cut, or Russia's going to cut half a million. We as a group are going to do 1 million. To which Russia then turned around and went, no, we're not, and walked away from it. So when they did that, there was then no deal, no cut. Oil dropped from 42 to 30 overnight. When that happened, that was then the beginning of the full-on panic, because suddenly you ended up with huge losses in oil, and that has knock on and knock on and knock on. Once that panic starts to set in, people have got to pay margin on these types of things. People need cash. What you will get is, rather than the standard, oh, this is bad, sell stocks, buy gold, buy bonds, you just get sell everything. So that was where it hit up here. That was then where it hit in gold. So you got like a couple of days of, well, gold not going up, but it wasn't going down. The S&P the equities just start to go. The equities are the best things in these because it just goes bad news, sell. Gold wouldn't go up. I think that tells you a lot. Well, if you've got something really bad and gold doesn't go up on it, that's getting to the point where people don't want anything but cash. Then you'll get the rollover and gold will go as well. And you'll see gold will drop, S&P will drop, bonds will drop, currencies will drop, everything will go down. So always a bad sign, or a sign that there's a serious problem, when you see bonds and stocks drop together. If they drop tick together, it's a real bad sign.
Because from a bond perspective, assuming that the world is going to hell in a handbasket and therefore the US government won't be able to pay as its...
That's the ultimate, extension of the idea.
It's the extreme of rates going up, prices going down.
Yeah,
And credit worthiness.
it's ultimately it's a credit thing then. Whether you're getting paid good interest or not, you don't care if you're not going to get the money back at all. So it then gets to a point where there's just no interest in anything apart from cash, which I always find as proof of this whole, you want gold in a crisis. Clearly you don't. Gold's useless. You can't do anything with gold. You can do something with, the other suggestion is tin, food and guns. At least they're practical.
You can burn money and make a fire.
Sorry?
You can burn money and make a fire.
That's a better point actually. Yeah, you can't even melt gold because you need to get so hot to melt gold. It's hard to even.
The market's price it, because what I've got for gold, and I tell you it's worth $10,000. You don't know, if you're not a gold expert, to know whether it is. So you can't have, there's no market fairness, right? So
well, yeah.
you can't measure it.
Unless
I'll pay you the gold. How much is that worth? 5,000. How do I know?
well, it turns into the ultimate end to it. It becomes a barter economy.
Yeah.
I'll give you some beans if you're hungry for your gold. If I've got lots of beans, beans are suddenly worth a lot more than gold.
Exactly.
Or I've got a gun and I'll take your gold and your beans.
And your gold.
Yeah. So that's what ends up happening. Ultimately, what you end up with is essentially a cycle down quality or a cycle up quality. So what I mean by that is if you take treasuries, bunds and Italian BTPs, this is yields, so this is selling off of bonds. What you get is the Italian BTPs just get smoked from the beginning. They're sort of not massively creditworthy. They trade like equities almost straight off, and everyone just tries to run from them. So you get in Europe a run from BTPs to bunds, and then eventually you get a move from bunds to treasuries, and then eventually you get a move from treasuries to cash. So from the beginning, BTPs just went down, 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 and the yields flew. Once, or at the initial part of COVID, but BTP sells off, bunds bid up on a safety, buy bonds and sell BTPs, or buy bunds, sell BTPs. Once Russia walks away from the deal and you get the full-on panic, you then get the selling of the bunds as well, and the bund more than doubles back on the initial move. And the treasuries do as well. The only thing that didn't bounce in quite the same way was 2 years. The 2 years kind of did that and went sideways, because at the same time, then the Fed comes out and goes, rates cut QE, and that keeps the 2 years down. So the 2 years, the ultimate safest thing to go to if you don't just go cash. So that's where everyone goes. It's like the most liquid place to go. So you get the move to the 2 years. They're the ones that won't move too much, but everything else will sell off. Like I said, that's what you end up with. That's gold goes down 6%, S&P down, well, at a peak 25%. That's just in the 2 weeks after the deal. So they do the thing on the weekend, 2 weeks later, the S&P's down 25%, gold's down 12%. The only thing that goes up is the dollar, and that goes up about 7%. That all happens until they start to introduce swap lines. Swap lines solve the dollar problem of everyone wanting to buy dollars. So the swap line solved that, which also turns gold as well, because the gold will just follow the dollar generally. And then the final sort of solution, which is always the kind of ultimate end, I don't know that there is anything beyond that, is QE. And once they do QE, that's it. That should theoretically be the problem solved. If that doesn't solve the problem, I don't know what the solution is. I've never seen it. It solved the problem then. That's the difference between 08 and 2020, which is not massively relevant. The one takeaway from that is that on all of these types of things, when you get this run from everything, of the major currencies, the one that people seem to run from the most is the pound. I don't know why. A few other people mentioned it to me and they said, I don't know why it happens, but people run from the pound more so than anything else. So that's the place to be. Yeah, well, like you see, it went down 12% and it went down 20% in 2008. Then you get the QE, and the QE solves the problem. Excuse me. That was various kind of talk of it. It started getting talked about really early on. So early Feb that they've talked to swap lines, and then you start getting more and more and more discussion on this. I think the idea of talking about it is part of the clue that this is going to start to have a big impact.
Is the increase in QE just to increase the money supply to cause people to spend more money in the economy?
Yes, theoretically.
Okay.
It's
after oil crash or something?
Yeah, it wouldn't necessarily be done after an oil. Yeah, if it's just oil that drops, that's an oil problem. Yeah, that's something to do with what's going on in the oil market. It's more a case of if this is a problem, essentially that they can't fix by cutting rates because they're cut to zero now. Yeah. The next step, the only way you can get yields to fall, i.e. money to get cheaper if you're already at zero, is by increasing the amount of money out there. So then people are more free to actually go and buy stuff. It also helps the banks. Yeah, the big problem here is the banks won't lend money to each other. If you massively increase the amount of money that's out there, you're more comfortable to lend money to a bank who's just been able to sell 5 billion, 10 billion, 20 billion worth of treasuries to the Fed, and now they have got loads of money. You know it because you've also done the same, so everyone's got loads of money now. Everyone's quite happy to lend, and that theoretically, well, it solves the credit problem, and as soon as you solve the credit problem, then they will lend to other people as well, because you can kind of afford the risk of lending to another company. So they do more swap lines, more QE on the 15th, so that was then the following week. They then do repos as well. This is just a litany of different new things that they could do, or not even new things, just bringing out the old stuff. Rates go down, swap lines, QE, repos, and then it still doesn't solve the problem. The final solution to the problem is they bring in QE on an unlimited scale, which was this one. This was the final bit that you weren't waiting, you didn't know the scale with which they would do it, but you knew that something was probably going to come. This was the final bit of it. Quite confusing because they did about 5 or 6 different things, but the key line was that they would do it in amounts needed to ensure smooth market functioning.
So they don't use the term quantitative easing, but
no.
We just look for
purchase of treasuries and agency MBS is what they're going to do, or just treasuries. But it's anything that a central bank says outright purchases. If they're going to buy stuff, that's QE because they're going to print money.
Means whatever they need to do, basically.
Yeah, exactly. They did it when this was why it was referred to as unlimited QE, because they did, they said 125 billion every day, which compared to original QE at its peak, they were doing 95 billion a month, so they were doing 125 a day. And compared to what the ECB had done, they eclipsed the ECB in about a week, had done more QE in a week than the ECB had promised for the entirety of COVID. The ECB is useless.
They can only buy bonds to do quantitative easing? Or?
Sorry?
They can only buy bonds to do quantitative easing?
Depends on the central bank. The Fed can only buy bonds. They can buy treasuries and agency MBS. I'm going to get into agency MBS. The Bank of England can buy gilts, so you can only buy your bonds. Bank of Japan seems to have thrown the rule book out the window and they buy anything. They bought bonds, they bought ETFs, they bought equities, they bought almost anything. The Swiss National Bank's the same. But in general, the rule is that pretty much the only rule is you cannot buy direct from the treasury, i.e. your central bank can't print money and give it straight to you because that's seen as what Europe refers to as monetary financing. i.e. you can't be the person who prints the money and borrows the money at the same time.
Okay, so you've got to do some sort of transaction in between.
Well, yeah, because essentially what it does is by increasing QE, more money, bond prices rally because, well, the Fed's going to buy bonds. Prices go up, right? So as prices go up, yields drop. Now, when the Treasury sells bonds, they can sell them with a lower yield. There's no need to sell them at 4%. They can sell them with a 0.5% coupon, i.e. that's what the Fed's going to pay in interest, the Treasury's going to pay in interest because the Fed has bought all the other bonds out there and pushed the yields down. So effectively they are, but they're not. Because
Spurs growth, however you would say it, because people get away from bonds into other assets.
That's the theory. The idea is if you do QE, you make money cheap, you push more money into the economy, people with more money spend more money, particularly if it's more money you didn't expect to have. That should then help the economic recovery. The problem with QE is that what happens in reality is money goes into bonds, the money goes into banks, and people buy assets. So asset prices skyrocket. Doesn't massively improve the ability of banks to lend money because they're now cautious. They don't want to lend to you and I who, well, in 2008, many you and I's were the cause of the problem. So they don't want to lend money. So they still don't lend money to individuals. And the only people they do lend money to are people who are very comfortably able to pay the money back, who then go, brilliant, 0.01% borrowing cost to buy stocks, fantastic. Buy stocks, buy houses, buy art, buy anything that's got a yield on it. And those things all increase in value. Doesn't massively help.
$75 billion worth of treasuries per day, GPT tells me that equates to 750,000 contracts in the 10 year.
Oh, well, there you go.
$100,000 per contract.
Yes, that'd be right. Yeah, so effectively, yeah, that's what you would expect the level of buying to come in.
Ask you what's in the daily bond.
Bear in mind though, that's across all treasuries,
Yes,
so it's not going to be just. But effectively, it just adds. Even if you don't see it on the ladder, you know it's coming. What they also do is they will say when they're going to do it. They call it an open market operation, yes. So that like the way the Treasury auctions bonds, the Fed on a day-to-day basis, I'll see if I can find an example, offers a repo. I think it's usually 6 p.m. And what they will do in these instances is it's what you call POMO, which is a permanent open market operation, i.e. we will permanently buy the stuff. We're not asking for it back. We will just buy. And they will put how much they're going to buy each day. Doesn't necessarily mean they're just going to go, right, it's 6 p.m, buy. But you can start to see that type of flow come in.
They would use algorithms, wouldn't they? Or?
The Fed, yeah, I don't think there's,
They get back, presumably they'll execute with banks, right, as opposed to...
They do have their own trading desk. Yeah, the New York Fed has its own trading desk. I can't remember what it's called, but they do. They have their own trading desk that does it. So they will get on with it. This is then the reaction that you got, far more sustained, although the S&P did, as always, come back. Standard stuff, even on unlimited QE. But it was a far more sustained 160 handle move over the course of, well, that's about 15 minutes. T-notes go quicker on these ones. And unlike a rate cut, the bonds do go up because they're actually going to buy the bonds. It's not a cut in rates, so well, buy stocks, it solves the problem. They will buy bonds. The S&P incidentally had traded limit down just before this. So traded limit down, bounced off the open. You do wonder if people thought maybe something's coming here. And then you got that. I've got a very quick bit of it. I'll post these ones up so I want to make sure we get onto some of the correlation stuff. The main bit on this, more so than anything else, is before the turn of every hour, put your mouse above the S&P or what an equity market. Put your mouse way above market with a decent clip, just in case it starts to move. The approach, I guarantee for this trader at least, will be if it moves up, just buy it and then work out what's happened on the basis that they're not going to put out something really bad on the turn of the hour. So you just go, well, it skipped up, buy it. It's the only way you're going to be quick enough on some of these things. That's the idea. You get the Bloomberg red head, extensive new measures, open-ended treasury and MBS buying in the amount needed. So it's not exactly totally clear on what precisely, but the whole idea is you know that this is big. And if it's come from the Fed, it's definitely a big deal and it's hardly likely to be bad news. So you buy the S&P. The S&P is generally the first place you would go on a lot of these types of things. Once you then work out what the story is and what exactly has happened, the next place to go is treasuries. The idea then is you just try and build positions, hold positions. Yeah, this is massive news, so you don't
So
kind of
he
give it.
keeps adding in on the right. Yeah. On the way
Yeah.
up. Is he taking out?
Yeah, so that's the size that's up there.
Okay.
So the way he always does it is he'll go in, out as it flicks up, and then he'll go in again. So I would expect you'll see, there you go, he tries to buy it as it gets to highs.
Yeah.
The idea of that
Keeps flying back.
is you buy it as it goes to the high on the basis you hit it there and it jumps through the high, you can hold that position. If it doesn't, which is what happened there, then he'll fire a load of offers to get out. So the idea is this, so there's a lot of time I've spoken to about it, I'm like, you're a really inefficient way of doing things. Like, yeah, but it's the way that I stay in the trade. If it's just a case of hit it and stay in, he'll just scale, and you get to here and he's got very little left. Okay. So the idea is if you hit it and it goes, you've then hit another 80, it jumps, you scale out of 40 and you've now increased your total position by 40, and then you play the game again and again. So there are, on the whole, a very large number of scratches, but you're playing for the one that you don't scratch and it runs and it goes. Also, part of the theory or part of the strategy around this is if you spend your time watching the S&P and managing the S&P and trying to hit that through highs and dealing with that, you carry the treasury position for longer. So you don't mess around with this one so much. You can kind of just leave it to it and deal with the more volatile markets. That's the reason as well to hit multiple. So most people, yeah, I was always very much of the view, well, why do I want to hit Euro stocks and S&P and treasuries if I can just hit twice the size in S&P? And the rationale is, well, twofold. One, you don't know which one's going to go the furthest. And say on this news to start with, theoretically the treasuries should be the ones that really go. But you didn't know that when you saw it's a treasury, it's a Fed headline, just hit it, and then you work out the story. Oh, maybe I should have gone treasuries. You don't know which one's going to go furthest. And also by dealing with one, you have a greater chance of holding the others. If you just go with one, you don't run the risk, but it's harder and harder to hold that type of trade.
Neil would just literally get into that without even knowing what headline is if he sees it move.
Pretty much, well, on the time. So yeah, it's midday and it goes tick tick
yeah.
and you hit it. That was always a strategy that a lot of us used sort of through any of these types of crises. My strategy was always you buy it just before anyway. So it's unlikely to go just straight down. And if you buy it just before and it ticks up, then you're already in something and you can add on.
Sorry, Rich, what does MBS mean? MBS what?
Mortgage-backed securities. It's a very complex.
How much did you make this day?
He's up 300 on that trade, 300 grand on that trade. So yeah, pretty decent. I'll post the whole video up. I'll get to the end. Oops.
How much? What account size would that be? To get 100
I couldn't tell you precisely. A good way of making an assumption on account size is less about the upside, more about the downside.
I mean, like just for margin, like $1 million, you'd be able to trade 100 contracts or no?
No. No, you'd need more than 1 million to trade that amount of contracts.
I was
Yeah.
going to say 450 on one.
Treasuries.
Yeah.
Treasury margin's not that high. I think treasury margin's about 2,000.
The far right is S&P.
That's S&P, yeah. So yeah, I mean, I think at one point you had 250 S&Ps on at some point. But yeah, an S&P at the time I think was about $8,000 per contract. So I'll let you do the maths on that. So yeah, 100 lots is 800 grand. So 250 lots would be what?
1.8.
Yeah, just over 2 million
Yeah.
or 2 million. Bearing in mind though, this is the whole point of why you're a prop firm, you don't have to have all that money in your account. If you have all of that money for the margin, then you get 100% split. If you give away some split, then we front the margin.
What do you mean as a prop firm on paper you don't have the money?
No,
The prop firm has the money. So let's say you want 2 million of margin, you don't necessarily have to hold 2 million in your trading account. You could have 500,000 in your trading account and trade 2 million margin because we would effectively pay the rest of the margin for you. It's how a lot of most brokerage accounts work like that as well. They leverage people insanely. Places like AMP, for example, will offer you day trade margin of $300 on an S&P. You do have to bear in mind when someone initiates a trade, you have to pay full margin. There's no getting around that. It's not at the end of the day. You have to front the margin to start with. So
That's cheap, that's very cheap.
yeah, so if they're offering you that, someone's fronting that margin.
Per contract.
I think it's 300,
Nice.
something like that. But yeah, it's quite low. But yeah, so on the upside, it's hard to tell. The general rule is that your account's going to be roughly 10 times whatever your biggest loss would be, or your biggest allowable loss. Most people wouldn't let people go lose more than 10% on a day generally. So it also depends on who you are and the way you trade. Someone like him is going to require more money in their account because he's much more volatile in his performance, as in he could swing 100 grand down a day, despite the fact he has bigger up days. There are some traders who don't have the down days like that, really, really tight on down days, don't have big down days, but could have a 10, 15, 20 times that up day. Those people will have a lot more margin for account size. It depends on the way you trade, basically. More swingy, volatile people get less margin, essentially.
What about people that don't have any money to bring house?
Well, then it's a case of whether we're willing to front the margin for someone completely and take the risk that they lose.
And you take all their profits until they can build up a...
You don't take all their profits, otherwise why would you do it? Yeah, you would do it.
Slavery.
Yeah, yeah, exactly. No, you don't take all their profits.
Yeah, we might predict it like 70-30 split or something towards a prop firm.
No, it starts at 50-50. Right.
How long does it take to build up, like to get to, it's probably a decade to get really big, or
No,
shorter than that?
3 years, 3 to 5 years. I say, yeah, there's lines of what do you consider really, really big. The capacity to make 500 to 1 million in a year, I think you can do within 5 years.
Richard, I just have a question. How does the scaling work, or do you do scaling in Axia?
In what sense?
Do you scale the account size? Increase by 10% or 20% dependent on performance?
No, so your account just goes up based on performance. So yeah, basically you think of it like this, you slightly off topic, but you start with an account at 0, you have an overdraft of, let's call it 10K. If you hit that, no more trading, or unless you front your own money. Once you go up, it's whatever money you make and keep in. The more money you keep in, the more size you get. If you want to just take money every month and wind yourself back down like that, your size won't increase. So
Do you have to pay that 10K back if you lose, or?
no, that's our risk. That's the whole point.
If you want to sign me, I can work the deal in your favour greatly, like I pay the
Right.
10K back.
It's more about whether we think you're going to make money than whether the deal works in our favour. I don't want 70% of someone who doesn't make money, because at the end of the day you still lost money. It's whether we believe someone's going to make money. If we believe they'll make money, there's no point in giving them a bad split, because then they won't stay. Right, anyway, we'll do a bit on correlation. We'll touch on the sort of basic sort of idea on what most people consider correlation, and we'll go on to a bit on bonds this afternoon. Right, sorry, Darius, I missed your question on the limit down. Personally, if European markets reverse whilst the S&P has gone limit and is then reopening, or in the process of reopening, would I play it the other way? Personally, no. I'd never buy the limit down. Certainly not when you're very close to the open. The only times I've ever had to go buying limit down was on the Donald Trump first election, on the basis that if it got stuck on the limit pre-cash, that limit only locks at 225. So if you're buying that at 3 o'clock in the morning, the idea is I've got about 10 hours to get out of this trade by joining the offer and waiting for it to tick me out. So it was safe to have a go at buying it. And the only reason for doing that was the move was a carbon copy of Brexit. So I thought, well, there's value in this, and I've got 10 hours to get out if it doesn't look good. It didn't look good. I got out, it jumps off the limit and went straight up. But there you go. Right, bit on correlation trading. First thing is, correlation is not causation. For one, I'll leave you guys to think about that in a bit more detail. Generalized correlations, I think what most people assume is that, or they go to as the default correlation, is stocks and bonds going opposite directions. On the whole, yes, but there are situations when they don't, which we'll come on to in a little bit. Other correlations, dollar and commodities is pretty straightforward. Almost all commodities are priced in dollars. Therefore, a strengthening dollar is negative for commodities on the whole. Obviously, there's other factors in this. If there is a huge supply issue in oil prices will go up even if dollar is strengthening.
Gold's not back to the dollar anymore.
Gold's priced in dollars. Gold's the most reactive to the dollar because gold doesn't really have that much else that factors into its functioning. You know, things like industrial commodities, oil and copper and stuff like that. If people need oil to do stuff, to travel, if you need copper to produce stuff, your input costs go up if the dollar strengthens, but you still need the stuff.
So gold and dollar should have a positive correlation to your dash of dollars and the
Yes. So you look at now, since the US election, you've seen massive dollar strengthening and gold has absolutely fallen out of the sky. It's a really clear correlation. If you get a chart, the best one to do is do euro dollar. It's the easiest one because the euro dollar is 60% of dollar index. So that's always my go-to. The other way to do it as well, if you're unsure whether it's dollar strength or not, if you put a euro dollar and a sterling dollar next to each other, if they're both going down, it's dollar strength. If the euro's going down and the pound's not moving, it's euro weakness. Because if it was dollar strength, it was strengthening against everything. So generally, if you're seeing dollar strength, that will have an impact on commodities. The common one that I often get asked is, what about Canadian dollar strength on oil? Canada produces a huge amount of oil. Doesn't work that way round. Oil price impacts Canadian dollar. Canadian dollar does not impact oil price. It's the same with milk and New Zealand dollar, copper and Aussie dollar, all of those types of correlations. They will be impacted by the commodity, not the other way around. The only currency that impacts commodities is the dollar, US. The other one's yields and currencies. I'll show you an example of this this afternoon. The whole idea of yield and currency is to do with, if yields are rising in one currency, that currency should strengthen. You look at what's happened very recently with the difference between the yields in Europe versus America. American yields have risen. You've seen treasuries sell off. And as that's happened, then you start to see the euro dollar fall, because if you've got a choice as to where you're going to put your money, you might as well put it into treasuries than you had into bonds. So that's also partly the factor of interest rate movement. That's one of the biggest factors, to be fair, in terms of currency movement, is relative and expected change in interest rates. So we'll cover the theory on that a little bit this afternoon. I'll give you a couple of examples of just straightforward use of correlation. A lot of the time that most people are going to use it, it's not a generalized type of thing. For example, like I said, dollar strengthening, gold's dropping, right? That can help you in terms of a bias. And like I was talking about yesterday, when we were looking at that gold moving down, you wanted to see the euro keep going with it. And we looked at that yesterday, how once the euro bounced and gold was seeming to not go down, then gold had that release to the upside. That's more where you're using it in a specific situation, rather than just going, well, euro dollar's down today, I'm just going to sell gold. You've still got to bring it down to, is this the right place to sell gold? So a lot of it's down to sort of enhancing a trade. It's something that you want to see as you enter a trade, or you want to see at the point of entry, or continuing to happen after the point of entry. Also prevents wrong trades. So a good example of something like this would be where you've got, that's the high of the day in the S&P and the NASDAQ, and you see the S&P's at the high of the day, you fancy this for a breakout, and the NASDAQ's done that and is trading there. it's going to be a lot harder for the S&P to break out without the NASDAQ. That's the bit that you've got to think about. So it prevents these types of trades. And the biggest mistake people go is that, well, they're correlating. They always do the same thing, and they've gone up. And yeah, on the day they've gone up, but that doesn't justify buying the S&P here if the NASDAQ's trading down there. It's, you know, and what you've got to do is you got to think about it in terms of they have a relationship. So for this relationship to have already got stretched the other way, as in the difference between the two is widening, it's going to find it hard to keep on widening. I try and sort of think of it as like a balloon with a weight on it. There's only so far the balloon can pull the weight up, or a person, a dog on a lead. There's only so much length in the lead before the dog gets pulled back, or the dog pulls you over, one or the other. So there is an element there, and that's the whole idea, that you can look at it and go, well, if I'm going to buy anything, I probably don't want to buy the S&P into resistance. If I really want to be long equities, I'm probably better to be long NASDAQ to play the catch up. Even if it doesn't break the high, that doesn't matter, but it's got the space to catch back up. Equally, if the S&P breaks the high and falls back, then you get the pull back towards the NASDAQ. So think about it like that. That, I think, is a really useful thing to look at. The other thing is just understanding the sort of context and the environment that you're in terms of the way that markets are reacting and the way that they're trading together. I've heard a few people refer the current movements as like the Trump trade. And the whole idea of the sort of current movement Trump trade is stronger dollar, weaker treasuries, or price-wise, so rising yields, which is a hedge against inflation. Gold selling off because of the stronger dollar, equities rallying, European equities falling, which is the way of playing various different versions of what you expect Trump to do. You know, probably the most obvious or distinct correlation at the moment is the S&P Euro stocks. If you look at the two of those, there's been a massive divergence in price. That's the S&P.
Why do you bring that up, Rich?
That's Euro stocks.
There'll always be correlations in play. You just have to find them, I guess, because money just doesn't disappear. It always flows somewhere else, even if it goes to cash.
Well, yeah, there's always a relationship in markets. You know, you take equity markets essentially move on the basis of, well, how well the economy is doing or perceived to do. So on the whole, American economy is not going to massively improve completely on its own because everyone's interlinked, right? What you're seeing at the moment, typically, it's a reasonably fair suggestion. You know, on the year, S&P's up on the year. Euro stocks is up on the year, so is DAX, so is FTSE, so is almost any other equity market you can name. I'm sure there are some exceptions, but there aren't many. Everything's up, right? I'll bring up I'll get one up for this afternoon of the relative difference of how all equity markets have moved over the year. So you're looking at a sort of generalized correlation that, you know, the basic rule is all equities will go up together, all bonds will move up or down together as well, whichever way they go. You're looking at the difference between the two. Now, the whole idea of the Trump trade is that Donald Trump's supposedly, or has talked about, and is probably quite likely to put tariffs on almost all trade partners. So by putting tariffs on, what happens is your products, if you're, say, Mercedes selling into America, America's now going to slap a 20% tariff, meaning that your cars effectively jump 20% in price, or you have to absorb that cost. So as you import a Mercedes into America, you pay 20% tax effectively to the US government. Now, you can then keep your prices the same as Europe and remain competitive against US cars, but you have to suck up that 20%, or you increase the price of your Mercedes in America, theoretically then no one will buy it and they'll buy American cars, which is theoretically good for America. You don't want to buy American cars because they're rubbish, but that's the whole idea of a tariff. It's a terrible, terrible, terrible idea economically. You can't universally outlaw it. If it was down to me, there would be no tariffs on anything anywhere, but it happens.
Depending on what the exchange rate is, would people even start selling the European stocks and buying American stocks?
Well, that's part of what's going on as well. Part of the reason that you're seeing European or Euro weakening against the dollar is that, well, exactly that. Why would you want to own something in Europe that's about to get massively taxed when you could go and buy stuff in America now that is unlikely to get taxed, and so alleviates that problem?
What exchange rate would you need for that to be a play? Like, it'd have to be fairly.
It's nothing to do with the exchange rate. It's about your perception of the relative value of the two things. You look at that. That's the election right there. Oh, sorry, that's the election there, right? If your perception is S&P is going to rally, they're going to put tariffs so Euro stocks is going to sell off. What do? Sell Euro stocks, take that money, which is then euros, convert your euros, so sell your euros and buy dollars, use your dollars to buy S&P. So therefore you have sold the euro, you have sold Euro stocks, which pushes down the European exchange rate, which then gives reason to go into the S&P. Over time, what this does affect is American exporters, because if I am buying something from Europe and buying something from America, I'm paying a higher price because the dollar is now more expensive. So think about going on holiday.
It's going to fuck the economy up more, even more.
Well, tariffs always do. But the whole point here is the Trump trade is sell stocks by S&P. The way then that you're looking at that, I don't think well, unless you're going to play this as a spread from the off and just go short, long and hold it. What you're mainly looking at is if you want to be short equity, so if you think the economy is not doing so well, or if you think there is some negative news out there, you're better off to sell Euro stocks because there's a lot of other negative things going on, rather than sell the S&P. If there's some positive news out there, you might as well buy the S&P because everyone's already happy buying it. Don't bother buying Euro stocks. That's the way that you want to try and sort of think about these things at the moment. In general, if the world economy grows over the next year, both of these will be higher. The S&P will go percentage-wise much higher than the Euro stocks will because of the tariffs theoretically. Incidentally, Europe has tariffs on American cars at a far higher rate than America does on European cars. That's one of the reasons why you don't see many American cars over here.
Aside from the orange.
Apart from the fact they're rubbish, but cost-wise, American cars are very expensive relative to European cars because Europe has a 20% import tax on American cars. Europe also has higher tariffs on aluminium, on a large number of other products, but no one worries about that. Ran over. I'll send this over. I actually did this for a previous group, so I thought rather than redraw the whole idea of it, but I'll try and send this one over, possibly with a little bit better drawn arrows on it. The whole idea of this is to try and explain, or to try and help you understand what is going on at any point in time based on the way markets are moving. Because correlation is not just as straightforward as, oh, it's risk on, buy equities, sell bonds. Well, what else happens? Yeah, you could argue that at the moment, but you're not seeing the same thing in the dollar. So it's not a straight risk on, this is a different situation. Generally on a risk on scenario, you would see the dollar weaken, you would see yen weaken because they're seen as risk currencies, they're the place you go for safety. We're not seeing that at the moment, yet you still got the standard risk on bonds and equities, but you're not seeing it in currencies. Commodities don't really match these. Commodities are a growth thing. The economy is growing and doing well, commodities will generally go up. Risk, they could go anywhere, dependent upon what the result is. You take the Ukraine-Russia crisis, risk on, things don't look so bad, sell commodities. You take 2020, the COVID crisis, things start to improve, risk on, buy commodities because they've been absolutely hammered. So commodities are a pretty bad judgment of this. They're okay on an individual country by country basis, but they're not wonderful as a general view. Gold, generally on a risk on, goes down. You sell gold, reason being, gold yields nothing. You don't get any return for holding gold apart from whether the price goes up or not. So if you don't get a return on it, you're better off to go and take that money and go and buy stocks, which you do get a return on, or even bonds. You still get a yield on a bond. You don't get anything on gold. Risk off's the opposite. Commodities, again, it could go anywhere dependent upon what the impact of that risk off is, whether it's a supply issue or a demand issue and what's been affected. You then have any kind of shock supply or demand, you will generally see equities sell off. So that becomes a risk type scenario as well. Anything that disrupts those things in a major way, you will generally see equities go down. If it's a demand shock, you would assume commodities go down, i.e. demand disappears. If it's a supply shock, then commodities will go up because demand for what is left comes in and people rush to buy. That's Ukraine versus COVID, effectively. Currencies will get affected dependent upon where that shock is happening. Probably the obvious ones that we've seen, or the obvious currencies you'd look towards, would be Aussie for copper, ruble for oil. You could look at Canadian dollar for oil as well. Brazilian reals for soybeans is a good one as well. That could be something that starts to happen as they put in more tariffs. The more tariffs it puts on China, the more demand for reals to buy soybeans from Brazil, because they're, I think, the second biggest producer of soybeans in the world. So soybeans from Brazil, wheat in Ukraine. So you need to understand the commodity relationship with different currencies.
What do you mean by risk on? Like if there's risk in the market?
Risk on is taking risk. So if you think of it like that, it's a chance to take risk. So the general play there is you go towards riskier assets, risk off, you take risk off. So it's, yeah, so what you are doing with risk. So are you putting it on or are you taking it off? That's the way to try and think about it. We'll come on to the inflation and the growth side of things, because that's probably slightly more bond visual than the others, because that will tell a story more on the relationship in the way bonds move, rather than just a straight, oh, bonds go up, bonds go down, because it depends on what the result or what the implication of those changes are going to be is. And then you've got panic, which is just a straightforward sell everything.
When these tariffs come out, what should China and Europe come to some sort of agreement?
Doesn't stop the tariffs.
Well, it could be a little risk for equities, no?
Not unless China has some kind of agreement where they would reduce tariffs on European stuff and Europe would reduce tariffs on Chinese stuff. You could get that as a sort of counter tariff measure. Until it starts getting talked about, I wouldn't worry about it, but it is a viable possibility, yeah, that you could have some kind of trade agreement between Europe and China. Generally, I wouldn't expect too much trade agreement between Europe and China. America's more inclined to trade with people because they'll pay money. Europe's less inclined to trade with people because of their political persuasions or attitudes societally. So there would be a grey area. Generally, what you want to be starting to get ready for over the coming days, weeks, months, and I'll give you an example of this to have a go at lunchtime, is which markets will get affected by tariffs. The main thing that everyone's going to be watching from now on, or particularly from when Trump actually gets in, Aussie dollar, copper, DAX, probably the main three. DAX is the European tariff play, because DAX is highly concentrated with cars, and cars are probably one of the main places they're going to put tariffs on. Copper, because that's a simple way of playing China, and Aussie dollar, because most copper comes from Australia, so the Aussie dollar will get hit. If they put tariffs on China, copper prices drop, Aussie dollar drops. And then the extension of that is possibly soybeans, and even then to a degree could come into cattle as well. So we'll see on that. There we go. Right, this one was on the order flow bit, so I won't go through this one too much. Actually, I might just pick it up. Let's pick it up. This is just a straightforward correlation trade in terms of right, maybe I can't find it. Right, I can't find that one, which is frustrating. If you go on the order flow videos, it's there. I'll see if I can find it for this afternoon, so I haven't prepped that one. But the whole idea here is using correlation to know when you can play a break of something. So this was a trade where basically you've got 3,700 sitting at the high. What you're looking at is look at an equivalent market. So just looking quite simple, where's the T-note trading at the same time that the Bund trades that large order? That way you can go, well, if the T-note breaks that level, theoretically the Bund should be able to go through that large order because the relationship between the two is widening. So that then gives you a play. As the T-note starts to break higher, you can then play through the large order. So it just helps add that little extra layer of, you don't want to front run a large order when you have a situation where your correlated market is continuing and continuing and continuing towards the upside. It's a really good example. I'll find the video of it. It was on the timing to have a go at it. It's a great example of this on the Fed in 2021, I think it was December Fed, where you have a situation very similar. Everything starts to rally, the S&P rallies, and somebody absorbs and just reloads 15,000 contracts on the offer. Trades. At the same time, gold goes up, euro goes up, everything goes up. And you sort of see it bounce. It gets tighter and tighter onto the large order or the reload. You know it's going through. So that becomes the play. So it's a good way to help you just go, I don't want to get too involved in trying to play a front run of this and get the sell off, because everyone front running it is waiting for it to do that. That's not going to happen if the T-note keeps on rallying. So what then happens is you can then start to hit through it. Think of it this way. If they were even there, the T-note's now trading here. It's a very safe trade to sell the T-note and buy the Bund and wait for them to equalize. If the Bund fails, the T-note will pull back. They'll pull it back, so you'll make money on the T-note. If the bund breaks, the bund will catch up with the T-note. This one may not move very much, but you'll make the money on the bund, so you're safe either way. Alternatively, from a day trading perspective, T-note's on the way up, just buy the bund for the break, because you can manage your risk much clearer on the bund, and also, if it does break, you've got the catch-up play. It's not loads, I think it's about 15 ticks that you get out of it.
You can do it, so it gives you more confidence.
Well, there's 3,500 on the offer. You could hit 1,000 on that if you want to, and you'll get filled. Well, and also you'll part contribute to it breaking, unless they come back and go 3,000 offered again, then you're in trouble. This is another example from a discussion. Somebody messaged me a while ago, and they're like, "I wanted to buy the bund. I didn't understand why anybody would sell it there." That was basically his message, and I said, "Well, what's that? Why have you come to that conclusion?" His conclusion was, "Well, the bund's going up, so's the T-note, so's gold. So surely it's a buy, why would you sell the bund?" And his play was to try and play the break of the high on the red arrow. It's all well and good, it's a nice idea. And yes, they've all correlated up. And this is why you can't just go on generalizations. If you're going to use gold and T-note as your reasoning to be in a trade, make sure you're very clear on what that reasoning is. You can't just get up here and go, well, they've generally all gone up. Because generally, bunds and T-note and gold will move roughly the same anyway. So on a day-to-day basis, if one of them's up, it's a reasonable guess the rest of them are as well. The problem he had is you can't buy bund for the break of the high if at the same time T-note isn't there and gold's nowhere near. That's the problem. Gold even more so. The high in gold was made way before the other two and it's not even gone back there. So yes, they're all up, but they're not doing the same thing anymore. Be really clear if you're going to use correlation, make sure you're looking at the same points across multiple markets. Don't sort of go into one and then go, oh yeah, well that one's going to help me out. The other thing on that as well, if you're using the idea of a correlation for your reason to get in the trade, then you can use it for your reason to get out. One of the things I hear so often is, oh, well, I was in and then it didn't look good in that market, so I got out. Don't make it an excuse to give up a trade. If you've got a reason to be in the trade and it also matches with, there's a correlation reason to be in the trade, great. But if you're just in the trade and then you go, oh no, but that's moved, that's not a good enough reason. That's just looking for excuses. So just be clear on that. This is one of my sort of favorite types of scenarios here, where if you've seen for the last couple of days a reasonably clear correlation in a couple of markets, so particularly in this example, a generalized bund rally, then drop, stock sell off, then rally, then what I'm looking for that following on from that is any time that then dislocates. So what you got in this scenario was after having seen pretty straightforward inverse correlation between the two, you then have a morning where stock sells off and the bund does nothing. That helps you out because what that suggests is one of these has got it wrong. Either the stocks has sold off for no reason and can't justify being down there, or the bund's not noticed the correlation that's been going on for the last few days and is not playing ball. What this would then lead you to is, well, if the stocks is right, the bund needs to rally. So you can play the break out of this little range. Play that to the upside. If the bund's right, then the stocks has gone too far and the stocks is going to come back. So it effectively makes it a buy for either of them on the basis that this one's got it wrong and it should be up here. You can play the break there and play that back. Or this one's got it wrong and it should be up there. In terms of a play, I'd far prefer to play the bund than the stocks here. Because if the correlation is starting to break down and actually the bund hasn't cottoned on yet, the stocks doesn't start to bounce and instead drops, the bund at some point is going to have to rally on it. Whereas I wouldn't massively want to buy the stocks because if the bund starts to then tick up the range, you're long stocks on the basis that you don't think it should be down there. The bund ticks up the range and that could then pull the stocks back down. And ultimately stocks has gone lower. So I would lean more towards trading the bund on this than anything else. The other thing you could do is if stocks rallies back, and I would be less inclined towards this, but on a quick move back in stocks, that might be enough to send the bund out of the range to the downside. But I'd just be a little bit more cautious of that because the stocks coming back could be just correcting. Doesn't mean the bund's got to go down. So just something that I quite like that idea where you get this situation where you can look and think one of these markets has got this wrong. Yeah, they were correlating quite clearly and now they're suddenly not. Good reason to give that one up. Right. I'll give you a quick example of one. This is a play in the DAX, trying to play a breakout whilst the bund breaks down. The problem with this, the problem with taking this trade on is the trying to play the DAX break when the bund's not actually really breaking down through anything. So the bund breaks down onto support whilst the DAX starts to break the high. Now the problem you're always going to have with that is that if the bund's running to support and has not broken support, and that's your reason for playing the long in the DAX, the bund can very easily bounce back on you. So you end up with a situation where you're long the DAX, but you're running out of reasons. The bund's got to go. And it's this move here. So he's playing the DAX long to try and get that move and get that break through the zone towards the upside. If the bund goes and breaks the low, wonderful. And then you can get this sort of continuation down and the continuation up in the DAX. But because the bund has not yet broken any support, it becomes a harder one for the DAX to keep on going. And it has to kind of force the break in the bund. What it also means is it's quite a nice one to play the reversal on the DAX. If it starts to go and then rolls back, you can then sell the DAX if the bund bounces off the lows. I'll try and give you an example of this one. So this is the trying to play the break towards the upside in the bund, and then trying to play the bund level, I think, is down at 30. So you can play the DAX long for the breakout. You can try and cover something at the previous box at 28 to 40, and try and sell the bund. That's all fine. But if the bund starts to struggle and it fails on the downside, you can't justify staying in the DAX. So that's the whole idea of the trade. You get into the bund, you're trying to play the break in both, and you play the two sides of the trade. Ultimately, what this does mean is you basically just doubled up the same trade. You could either go bigger on the DAX or bigger on the bund and do it like that. If you play them both, you're playing for that complete sort of widening, or not widening, but continuation of that counter direction.
If bund is at the high, near the highs, and DAX is near the lows.
Yeah, or you're even just playing a continuation. The problem with this trade, because I don't like to always just, oh yeah, look at this wonderful trade, look how it worked. The problem with this trade is the bund wasn't at the lows. The DAX was going back towards the highs, but the bund's falling into an area of support. So the problem you have with that is this might be a nice idea, but if the bund starts to bounce because they've been correlating well recently, the DAX is always going to struggle to keep on going. So part of the idea of a trade like this is you need the bund to go. If the bund goes, the DAX can go and break the high. But if this starts to bounce, that's where you end up in trouble in the DAX, and the DAX starts to roll back. The other side of that as a trade is, well, if this was the level, the bund then has an attempt down and bounces back. Anybody who's been playing this sort of correlation to be long the DAX is now running out of reasons. So the reversal trade in the DAX becomes a more viable opportunity, because the fact that the part of the reason to keep going up is that the bonds are now selling off, and if they're not, then you've got to look at that and think, this doesn't look great, I need to get out, I need to actually, I can justifiably sell the DAX now, particularly if the bund starts to tick up. Good way of trying to sort of look at these types of things is check the prices that you're at when the move starts to happen. So if the bund starts from 38 and the DAX from 20, that's fine in terms of where they are at the moment. But if the bund starts to get back through 38 and the DAX comes back below 20, you can then expect the counter move. They've kind of failed the continuation of what they were trying to do. That's the kind of aim of this, of sort of playing the trade like that.
Could you play a divergence trade if you had, let's say, Tino and bund, and let's say Tino is making higher highs, bund is making lower highs?
Yeah.
Could you take a short on that?
Well, short Tino.
Yeah.
Yeah, that's the way I would try and look at it, that they're only going to diverge for so long that you get, say, a T-note who does that, and at the same time the bund will do, say, that.
Yeah.
There's only so long the T-note can go before it rolls down. The bit that you've got to sort of work out if you're looking at it like that, because I really like that type of concept, is to go, well, what do I want to play? You can either play the T-note as a breakdown to play the catch-up, or you can play the bund as a break up to play it that way, because you don't know which one's going to go. Ultimately, if you think about the kind of dog on a lead idea, if the T-note keeps on going and going, this won't be able to stay down on its own.
Yeah.
If the T-note can't, because this pulls back too much, then the T-note will come back. So you don't know which one it's going to be. So you've got to kind of have a plan to play either of them.
Okay, you can short both, for example, or it wouldn't make sense.
A spread on, do you not?
You could just do it as a spread. That spread would be the simplest way to do it. You just go, well, they can't keep on going.
Yeah.
The hard bit of putting a spread on, if you put a spread on and then this does that, and then theoretically you should add to your spread because you'll be going offside on your spread, or you'll at least be going offside on the T-note leg, even if you're not going offside on the bund one.
Okay.
So that's the harder bit, to do it as a spread. But you could do it this way. Once the T-note starts to drop, you could do it like that and go, right, sell the T-note, and then you buy the Bund as well. You could try and sell them both, but what I would generally want to do.
It makes more sense to sell the T-note because it's higher up.
Sell the T-note for the reversal back or buy the Bund. Yeah, if I'm really trying to pick between them, I'd probably be more inclined to buy the Bund if they're both generally trending up, because then you're playing in the direction of the trend rather than selling the T-note against trend. Because if that just keeps on going, this will then play catch up. Whereas you could have a situation, if broadly the T-note is stronger, you might get the sell off and it sells off and then does that, and at the same time then the Bund plays catch up. So the kind of difference between the two widens throughout the day, and so any sell-offs in the T-note are more short-lived, and as soon as it then starts ticking up, eventually the Bund will get dragged with it. So I generally try and look at playing something in the direction of the current trend to catch up rather than the other way around. Yeah, if you've got technicals that really support you, you want to be short T-note, then it's an added bonus, and often that's a lot of it that you have to look and go, well, this is an added reason to be in this trade, so I can play it like that. On that point of equity bond correlation, a lot of it depends upon what is going on at any point in time, and what I would call a sort of policy versus economy correlation. When you have an economic driven correlation, bear in mind this is yield, and that's S&P. When you have an economy driven situation, what you will generally see is equities rally and bond yields go up. So they trade in the opposite direction. This, incidentally, is from the Trump election, there and there. So just in case you want to draw some conclusions from previous, this is what happened. Perception is the economy is growing, all is good. What you end up with is bond yields rally, equities rally. This is your straightforward inverse correlation. What you will then get is a situation where you've got this continuation, the economy's doing all right, the equities seem to think less so. So then you start to see a situation where you still have this generalized inverse correlation. The economy or the treasury yields continue to rise, the equities generally continue to rise. Then you get a situation where they both go counter each other. So you have a situation where ultimately throughout 2018, you've got rising bond yields and you've got flat equities. So you don't have that straightforward correlation anymore. You don't get this kind of bond sell off and equities rally. You now get in a situation where bonds sell off, yields continue to rise, equities struggle with that. There's only so far you can go of rising yields before equities can't cope anymore. And then you end up with a situation where to solve the rising yields, you need some kind of policy change, which is what you then get. And you get this policy driven change here, which sends equities up and it sends bond yields down. And that's the sort of solution to it. So you've got to sort of think about what's driving all of these things. Straight economic one, they should go inverse. When they stop being so inverse to each other, that's where you're then sort of seeing a change in the economy, a change in the perception as to whether they can effectively cope with these types of things. The equities decide they can't. Bond yields have to drop to accommodate that. And the only reason bond yields are going to drop is because policy is going to come in and solve the problem. You get the policy solution, which is then this bit, equities rally, bond yields now fall. So you then get in the opposite situation. Whereas before you were seeing economy's all good, sell bonds, buy stocks. Now you're seeing a situation where from a policy perspective, they're adding stimulus, cutting rates. Now it's buy bonds, buy stocks. So it depends what's driving. General form, they go together. Then you get COVID, stocks drop, buy bonds, back to standards of economic response. Then again, you get the policy response, which is buy bonds or at least don't sell them, and buy equities. So you then again don't get that same relationship.
So when it's economy driven, it's inversely proportional. When it's policy driven, it's correlated.
Yeah, as a general rule, yeah. Okay. So it's what matters in the economy at any point in time. You look at, say, 2022, equities broadly just sold off for 2022, and bonds sold off on the basis of higher interest rates and higher inflation. Since the US election, you're now getting the opposite. Equities rally, it's an economy thing. General sense that, well, things are going to improve. So buy equities, sell bonds, bond yields rise, equity prices rise. That's what you get. Right, What I'll do, I'll send you over one to have a go at on a risk on, risk off play. I'm just wondering whether to tell you what the result is or let you trade it without knowing what it is. I'll send it over. It's a risk on, risk off trade. What you want to do is trade it. Don't worry about charts. Trade it from the point of view of look at what moves and work out work out the correlation and trade it. So a good start will be to look at the S&P and then look at what else moves. I've got the list on there of the markets to trade. So you've then got to work out what exactly is the reason for the move. Give you a little clue, it's a tariff trade. It's the first bit, but I'll leave you guys to work out the rest of it. I'll send that over, I'll let you guys have a go at it over the break. We'll come back and cover the result, what happens, how you interpret it. I've also got a video of the execution of it as well. And then we'll do a little bit on bonds for this afternoon. But straightforward risk on, risk off. Move into risk on, you're buying equities, you're selling bonds. Risk off, you're selling equities, you're buying bonds. It's the straightforward reaction to that. Right, I'll send that over. We'll come back at 2 and we'll see how everyone got on in a little bit.
I think you're sitting there for talking about it sometimes, yeah.
So, correlations are the hardest thing to try and explain because it's always constantly changing. It's easy to sort of explain the basics of it, but there's so many ongoing permutations.